Welcome, everybody, to Drink While You Think. Today, we are going to be talking to one of my people in my favorite profession, the banking profession. So we're going to see if we can find a banker who gets it. I know everybody's skeptical, but that's what we're trying to do today on Drink While You Think. I'm your host, Matthew. You can see that my better half is not here today. Instead, we've gone in search of a banker that understands accounting firms. And we believe we can end that search now. Shannon, tell everybody who you are, and more importantly, tell us what you're drinking.
Wonderful. I'm Shannon Hay with Live Oak Bank. I am drinking Wilmington Brewing Company's Beach Time because I am actually, it doesn't look as lovely today as it usually does, but this is in Wilmington, North Carolina. That's the home of Live Oak Bank. And so this is a local brewery. And it is, let's see, El Dorado and Mosaic hops. It's a session IPA.
Awesome. And I'm drinking, sorry.
That's all right.
Blair's Breakfast Stout, also from Wilmington Brewery. How do you know this brewery? Is just one of your local favorites?
So this is, they're a local family. They started, they were home brewers at first, and they're actually now a staple of Wilmington. Every restaurant you go into will have a Wilmington Brewers on selection, Wilmington Brewing on selection. So wanted you guys to get a little taste of Wilmington. It's the best brewery.
And if Kenji had been here, he would be drinking the Tropical Lightning India Pale Ale you sent. So that's a hell of a call out, like knowing which one of us do which beers. I appreciate that, dude.
That one's a staple, by the way, Matt. It's actually served in every single restaurant in Wilmington.
Oh, really? That's
every single one.
The standby.
Yeah. That is the standby local brew. Yes, sir.
Oh, that's like on the menu. And I'm going to enjoy this in my Live Oak Bank coaster that you sent with us.
Love it. I wish I had one. I don't have one. Mine's sweating as we speak.
Oh, that's awesome.
Should have kept one for myself.
And I do this little plug for you. Today's sponsor of Drink While You Think is Live Oak Bank. Live Oak Bank is the premier bank of accountants everywhere. There they go.
Very good.
I love it. That's all I got for you. So that's pretty fun.
I appreciate it.
So I just wanted to tell everybody how we met. So when we were, like most accounting firms, we have niches, right? So all the bankers I know are great in their fields, right? Silicon Valley Bank, great for technology companies. Silvergate Bank, great for crypto companies, right? Like they're great. But when you go in your cloud accounting firm and you'd be like, I'm thinking about doing an acquisition, they start giggling and laughing at you like they don't know what to do in that. And after we did our first acquisition, we met you guys. And I think the first call we had, because we did it in the wrong order, and you can tell us the better order to do it next time. But we had bought the company and already done the deal, and then we had a reason that we needed to refinance it from circumstances that had changed with the person that sold the business to us. And our first call, you were like, you started rattling off the metrics you need in the diligence, like for the accounting firm acquisition. Mm-hmm. And I think it was the first thing you said. It was like, what's revenue per employee? How many 1040s are they doing? How many 1120s are they doing? Like, and you're like, man, you're speaking my language on the tax side here. Yeah. So I still think that if we had come to you before our first acquisition, we would have done better due diligence. And it's like undersold on like how great of a partners banks can be when they understand the space. Mm-hmm. Can you just talk about talk us through the first 5 or 10 items on your diligence list? Like if we're going to come and we're going to be like, hey, I'm starting due diligence on this thing. Like, sure. Just give people a glimpse into like some of the things, like what are the 5 most important things you're going to ask that are relevant to us?
Yeah. So I think I'd better off if I start first with kind of, letting everyone know specifically what I do. I only all day, every day, and my team, finance, accounting, and tax practices, right? So we're not, and I say this very frequently, we're not looking at a car wash one moment, a restaurant the next, and then turning to an accounting firm and trying to understand the semantics, the details of the financials, et cetera. Because we live and breathe in that space, we're able to recognize very quickly, the inner workings of a deal and how important or risky it may be for you. As far as due diligence, it's, for simple banking things, go to cash flow, right? That's always the big one. Is there enough income to service the debt and support you as a buyer? But then we dig deeper because we're so niche focused, industry focused, that we drop down into, the types of services that the firm offers. How old are the clients? How long has the current owner operated it? How long has the staff been there? Are there non-competes, restrictive covenants in place with the staff employment agreements? The list goes on and on and on. We do provide a business plan template that asks those questions and tries to help guide our buyers through the transaction process or through the due diligence process.
Yeah, one of my lessons learned through this, and it should have been intuitive. I've looked at a bunch of the stats on the angel investing side and totally separate for angel investments. You're talking about even bigger deals and people that like the stats on the angel investing side there's huge return gains if you at least do 20 hours of diligence, and then even better return gains after 40 hours of diligence. And that's just for small investments. You're talking about practice level investments here. One of the things that I wish I had done was kind of had your checklist going into my initial diligence. Like if we had partnered together, going in, it would have been a huge benefit. So what would it, if you're thinking about buying an accounting practice, what would be the sequence that you would recommend? I did it the wrong way. I'm coming to you on the back end and stuff like that.
Sure.
Talk about the right sequence to do it, because I've already messed it up. Right.
No, it's okay. The hard part is a lot of the practices that are listed. I always say the hard part, the great part about the industry, more so than other industries that we focus on, is this industry has a ton of intermediaries, like brokers that exist in the world. There's a large broker world. And so a lot of times if you're looking at that type of listing, it's difficult to get to those stages until you can even give an agreement, right? Most brokers won't let you see the paper, see the details until you've given some sort of letter of intent or what your intent is, what you're willing to pay, what portion you're willing to pay cash up front, what portion you're expecting to be a seller carry. Those times they want to know those details before they will, and they want to make sure you're qualified, right? They want to ensure that they're not wasting their seller's time, and give them the best qualified buyers possible. So you might get qualified a little bit before you ever get an opportunity to even get exposed to sort of that due diligence. It's the big thing I think is, first and foremost, you have to ask yourself, is this the type of business or type of practice I want to own? Right. So, when I think you're thinking from Acuity's level, it's probably grander in scale, right? But if you're thinking from the individual, first time buyer, or maybe I own a small firm and expanding to buy a second firm, types of service really should be driving your decision, right? Are you a personal tax preparer? Do you label yourself that, or do you like to spend more time in the advisory, bookkeeping, that type of service, right? And so make sure first and foremost it's you're barking up the right tree, I guess is the best way to say it. But
yeah, for sure. But then how do we not mess it up when we get to you? What point do we engage you in the process? And
so
how does that feel?
So I'm always I have a lot of these conversations daily, and customers ask me that frequently, and it's usually the letter of intent, right? That's sort of our trigger point as a bank to get involved, mostly because it's difficult to talk about the details or decisions on a deal until we know what you're willing to pay for it, right? Or what you're going to pay for it. And then as well, what the terms and the structure of the deal are. As I said before, how much seller participation, how much down payment, so on and so forth. That all kind of plays into it. But letter of intent, I would say, really pre-letter of intent might be a good preliminary conversation with the bank, just so you know that you have a bank that understands what you're doing, how you're doing it, and that they're going to support you in doing that.
And I think I've come to realize that 90+% of these deals get SBA backed, right? I think that's what it was. So you were really helpful for me in understanding here's how this impacts the letter of intent. Can you talk about some of the deal breakers? We talked about how long the other owner can stay on, those.
Sure.
What are some of the deal breakers in the LOI for people to start thinking about if they're thinking about this?
Well, so it does vary from SBA lending to conventional lending, right? SBA lending definitely has certain parameters around it, or what we call there's the SOP, right? So it's the operating procedure of the SBA and how things have to, kind of fit in this box. And so it doesn't really translate well to the accounting world, right? There's certain rules that just really conflict with what a lot of the accounting world says a good transition looks like, or a good deal looks like. And so what we've learned to do is sort of massage those variables to meet the SBA needs while meeting our clients' needs at the same time. But some of the big rules that kind of get hung up on is there's no earnout in SBA, right? That's faux pas, verbiage. You're not even allowed to use the terminology earn out, whether it's in a letter of intent or in an asset purchase agreement. So every SBA lender is going to balk at the terminology earn out. Now, however, there is interpretation in what the SOP says, and there are ways to word things that might not, that kind of work into that gray area or that non-black and white. And I like to refer to it as retention agreements or attrition clauses, right? So we get away from the earnout terminology, and then we start to talk about what is an allowable terminology that also gives the buyer the same tools that they would have if they were, say, seller financing, or say they were doing mostly cash at closing and then having some terms to seller post acquisition. So we set up what we call retention agreements, basically. And the SBA is really driven to today's value of the firm, right? And that's the way they operate on all their financing for all their businesses, is that really any transaction greater than $250,000 requires a third-party business evaluation. And then the SBA will only allow you to loan up to that amount. And so getting back to the retention, right, we always like to take a portion, set it aside. We can do that in a number of ways, right? We can finance that and we can put that into an escrow. The seller can carry it and hold it back. But then we'd like to see you work towards the revenue, like a revenue benchmark. So you're buying a firm today, the revenues are $1 million. You want that revenue benchmark to be $1 million a year from now, and you want that escrow or that seller portion to be tied to that. But it can only adjust downward in the SBA's eyes, because the SBA is only going to do things that are beneficial to you as a borrower, right, or a buyer. They're not really looking to help the seller too much on that side of the equation, because we're establishing value. We're paying you for value on day one. We don't want to talk about future value. Future value belongs to the buyer. This is the way the SBA sees it. Yeah,
that's an awesome one. And then how long the person could stay on is a big deal.
Yeah, so the SBA does say that you cannot be, that the seller cannot be in a key management role greater than 12 months from the date of acquisition. That's the exact terminology. So it's seller cannot be in a key management role greater than 12 months from the date of acquisition. Well, what is that, right? What does key management mean? Really, it's receipt of proceeds, right? The SBA is trying to protect the borrower or buyer from receiving, from the seller receiving more of their goodwill or more proceeds towards their goodwill post-transaction date. So they're trying to push the seller away to simply create that separation of goodwill and the separation of revenue, right? So I always tend to say, and it's a little tougher on a podcast recording because I don't want this to be held against me at a later date, but that there's not really an employment police running around going, oh my gosh, is so-and-so working there? So you're the buyer, right? And you own the firm. It's really your decision as a business owner as to how you want to manage it and who you want to work there. It's really how you employ them, not who you employ, right? So take them out of a revenue sharing model, take them out of probably even a W-2 model, and let's hire them as a 1099 consultant if we want to keep them around for greater than a year, right?
That makes a ton of sense.
So there's workarounds, but you have to understand, I think, the original purpose as to why they have it. Remember, the SBA wasn't built for accounting firms, right? It was built for all businesses. And so they're drawing these rules around probably problems they've had with businesses in the past in transitions, and they're laying them into future deals.
Yeah. That makes a lot of sense for what we were talking about. So we talked a lot about the SBA. Like, what's your take on, like, if you're a firm owner, like, should we care if it's SBA? Should we think more about conventional? What are the cost trade-offs? Like, how should we be thinking as firm owners? Like, it's kind of a pipe dream to do conventional. Let's be real. Let's be real.
So you got to think of it. I would think I'd think of it from the bank's perspective, right? It's we know that this is a goodwill transaction, right? We know that it's not really asset based. We quantify it in value based on the evaluation of that goodwill. And so the SBA has sort of proven itself in the last 2 years, especially during COVID, why it's a valuable program. If you had an SBA 7A loan during the summer of 2019, you got 6 months of your payments paid for free by the federal government. I didn't say deferred. I didn't say waive. They were paid, physically paid by the federal government, principal and interest. So if you had a $5 million SBA 7A loan and your monthly payment was $60,000 a month, you got $300,000 in payment reductions from the SBA, right? That's a pretty big deal to a bank when you're coming off the backside of a pandemic. It's like sort of hard to, because the federal government wasn't reaching into conventional loans. Now that's just one point. Conventional terms are generally shorter, right? So they're going to be 7-year terms. Now we do conventional. We are the nation's largest SBA lender, but we do conventional deals. A lot of times we do it as a supplement to SBA. So first 5 million will be SBA because that's the SBA lending limit. The next 5 million can be conventional, and we would certainly look to do that. But foundationally, what we're trying to do is lay down a relationship, protect ourselves, allow you enough runway to build your business, but then, but create something that has a greater value conventionally, and then allows you to move to that conventional side. So
we always think because we're the customer in this case, we have the opposite approach when our customers come to us, that you should do things immediately.
Yes.
So like I should come to you and you should give me a blank check tomorrow.
Yes,
so that's how I think, because we're responsible accountants and things like that. But
yes.
Can you talk about reasonable timelines for people, and like how much, if you go the SBA track, how long things will happen, and if you go the other track, how long it'll happen? Just because I think there's some misconceptions about that. I think we have some unrealistic expectations of how fast you can get a deal done.
Yeah. I think that first and foremost, there's also some unrealistic, there's a lot of negative connotations around the SBA, right? And so whenever someone says SBA, it's like first blood of the firstborn is what people think, right? And it can be a tumultuous loan process with the SBA. However, I would recommend that if you're going to work with the SBA, which if you're doing a goodwill acquisition, you likely are going to have to, that you choose a lender that does it frequently, is a PLP lender, which is a preferred lending provider of the SBA, and you just has overall experience. Believe it or not, a lot of the large banks don't have real SBA experience. They're really well at servicing the retail side, the large commercial side, but when it comes to that small business niche, they struggle with themselves. And so I would say it's really kind of who you choose as to how the process kind of can work out for you. Live Oak Bank being the nation's largest, right? We have a lot of practice. We do it in and out, and so day in and day out. And so we say our goal is 45 days from start to finish, from application to close. That's our goal. Now, the average is 60, right? The average borrower will take 60 days, mostly because you fumble in certain places in certain parts of the paperwork, whether it's life insurance or, maybe it's even a lot of times the asset purchase agreement of a deal is the one big hang up that, it's going back and forth between attorneys and never really given to the bank to have any say into it. And then finally, like a week before they want to close, oh, here's the asset purchase agreement, but it's never been reviewed by bank counsel, right? And then bank counsel gets a hold of it. And so that's another equation. But again, start to finish, call me, you start your application process. Within 2 to 3 business days, we're issuing you a loan proposal or we have questions. You sign the proposal, send it back. We get you into underwriting. The underwriting process is about a 7 to 10 business day process. Then we issue a loan commitment once we have an approval, and then we move you into the closing process. And that's generally about a 30-day process from start to finish. So
that's great.
Yeah.
That's really helpful context. I think is that relatively similar on the conventional side, or is there any big differences?
No, there's not really, when you think about what are the things that are hanging up an SBA loan, and a lot of times it's business valuations, appraisals, title reports, lien searches, third-party things that are really out of everyone's control. Those are all requirements of conventional loan too, right? So we're going to want all that same due diligence on a conventional side of the house. So I would say, you might be able to squeeze it down because there might be a couple variables, and maybe you could get down to 30 days. but I've closed both very quickly, and I've also had very long processes with both. Right.
Mm-hmm.
It's really, it's really not a lot of people want to blame the bank, right? It's the bank's responsibility for my timeline of closing. I would say, and not to be harsh, but it's really the borrower's responsibility. You're given a checklist from the beginning of the things you have to provide, and follow the list and check the boxes. And if you provide it all and put it back in the bank's lap, now you can blame the bank. But if you're still holding on to certain items that the bank's requesting, then the delay is not really on the bank. Fairly. Hopefully that's fair.
Yeah, I think that is fair, actually. Although I like to make fun of bankers all the time.
I do too. So feel free. We have beer. So
don't worry. I'll continue. I'll continue to make fun of you. The thing that always bothers me about bankers is I always feel like they never lend us money unless we don't need money, and then whenever we need money, they don't want to lend us money. So that's always my number one gripe about bankers.
Well, Matt, the bankers have the same joke. I just say to all my customers, I'm like, banks love to lend you money when you have it.
Yeah,
it's a lot more, but I would say it's not really about what you have. It's about proving what. Well, you do have to have some, right? Down payment requirement. You want to have some liquidity as a backstop. You can't expect the bank to carry all your risk. Like your down payment is kind of your skin in the game, right? And then they want to make sure that after the deal closes that you have a little bit of wherewithal, right? Yeah. It can't be the bank's full responsibility to cover your wherewithal. And if you can prove those two variables, keep a little cash after your down payment, then and you got good credit and you've got experience in the industry, it's not as bad as it seems.
Look at you defending your credit department. I know how you really feel.
I'm a good banker. What do you want from me?
Credit departments do have mood changes. You have to admit, like the credit department does go through mood swings.
Yeah. So. I mean, it's especially with the rising interest rate environment, a volatile financial, overall picture, it's, you got the inflation looming. Yeah. I would say they're probably a little, they change with the spirit of everything, right? You should have seen them during COVID.
Yeah. I have a question for you. Because it feels like when I was going through some of the stuff that with you, like, I know you're probably doing a bunch of retiring partners, buying those kind of people. Those tend to be older school practices. What trends or changes are you seeing with these new cloud accounting practices? What challenges are people having since they may or may not be like traditional CPA firms? Or is there anything that we need to be paying attention to for those of us that are like in cloud accounting firms versus traditional practices when we're thinking about this?
Well, I would say, if you allow me to pick the subject, I'm just going to pick one that's, near and dear to everyone, I think, right now. And that's just talent, right? There's such a high demand for talent in all sides of the industry. In fact, I'm starting to see changes in why acquisitions are occurring, right? Like 2 or 3 years ago, acquisitions were occurring mostly for clients, mostly for billable hours, right? Mostly for revenue. And now I'm starting to see buyers coming to the fold that are buying for talent, that are buying for technology. Specifically in cloud accounting, no, I do think that the acquisition market has changed a little bit because you're starting to see firms being presented as cloud firms that just because they transitioned during COVID, they're now a virtual accounting firm. But I would say that every accounting firm is now a virtual accounting firm. And so there should be a clear delineation between if you're a fully nationwide accounting firm, virtual, right? Then your clients shouldn't all be in Atlanta, right? They shouldn't all be in one particular geographical region. You should have clients everywhere. You should have staff everywhere. Yeah. So I would caution, if you're in the market and you're looking to buy a cloud accounting firm, that, is it truly a cloud or a virtual accounting firm?
Is there anything on the banking side we need to think about with that too?
No, I would say that they seem to be valued at a higher level on the market, and that there's a much higher demand for that type of firm, especially when you're talking about recurring revenue bookkeeping type businesses. There seems to be a lot more folks coming to the space that are non-accountants, or I would say non-CPAs, or so some of those MBA type private equity type, sponsor finance type are coming into the market because they recognize the scalability of the businesses, and the recurring revenue models are very appealing to them. So I would say that's shifting the market a little bit. You're starting to see different buyers that aren't non-accountants coming to the fold.
That's really cool. Yeah, we've Growth Lab, Financial, and System 6 are two good examples of non-accountants running phenomenal practices, right? I'm sure there's lots of them, but like those are the two that pop in my head right away. Those guys are great.
Chris Williams is one of my favorite people. So he's a great dude. He's a great dude.
Great dude. He was at Accounting Web. We were talking before we started recording.
Yeah. I should have missed it. I'll be at Engage though. We'll hang out on Engage.
Yeah. Tell us a little about where you're going to be, because you're all over the place. You were just at PASBA.
I am. Yeah.
You said that was was that one this year?
So that was in Scottsdale. They actually have two. They have two sessions. This was their technology and marketing session, and it was at the Hyatt Resort in Scottsdale. Beautiful place. And then they have a fall session too that's in Orlando.
Okay.
In the fall, which is I think their management side of that's a great organization, Professional Association of Small Business Accountants.
Phenomenal group.
Great think tank. I mean, they just really love to share.
Yeah, so they're incredibly transparent group. I found it incredibly invaluable when I was a part of it to be in those groups.
But week after next, I'll be at Engage. A couple weeks later, I'll be at the National Association of Tax Preparers in Vegas as well. We do Thomson Reuters Synergy. We did the IRS tax forums. It found that it's a very difficult group to engage. It's like, or find, it's interesting. You walk around it like a PASBA, for example. You ask someone, do you know anybody buying or selling an accounting firm, or what are your succession plans? And there's always a thoughtful response. At the tax forums, it tends to be, why would I do that? And and a lot of diet your desk mentality in that. What I would say is the lower, not every person, obviously, but there's a lot more of it there than I would say at a more higher professional level. So
that makes a lot of sense. So you're going to be at a bunch of the upcoming conferences. The most one, as soon as this episode will drop next week. So we'll be it'll give people some notice. So if they listen to it over the weekend, then we'll be in Vegas. Come see both of us. Come see me and Kenji. Come see Shannon. It'll be fun.
Yeah, you got to work on Matt for that special invitation, though.
Oh yeah, anybody coming, any listener of this podcast is definitely invited to hanging out with us. We have some night events going on, so cool. Definitely ping us or shoot us a comment on social, and we'll tell you where we're going to be in the evenings at AICPA Engage in Vegas. It's our second year going, and it's going to be a lot of fun. A couple of never boring, at least.
Never boring.
So that's what's the best way to get in touch with you, man?
So I am on Twitter. I'm on tax Twitter at Shannon Hay at Shannon Hay LOB. I'm also Shannon.Hay at liveoak.bank. And then I'm not scared to get my cell phone out to everyone and anyone. So it's 614-648-9199.
Oh, that's awesome. I told everybody this is a new kind of banker, like that understands us and gets us.
I answer my phone too. I answer my phone. A rarity, I know, in the banking world, but I do my problem.
I answer for unknowns, which drives Kenji batty. He thinks that's the silliest thing ever.
So I don't do the spam. I don't if it says
spam now, I don't do it now. It's like,
but I'll answer the unknowns.
It hurts me to not answer it, but I don't. That's pretty funny. Well, we rate our beers, and I'm not going to pull up the thing. I'm going to make Kenji do this for his homework. You rate our beers anywhere from 1 to 5 in quarter point increments, with 5 being the best. And I'll start here. The Blair's
version.
The Blair Untappd. Yeah, that's where we put it. Blair's Breakfast Stout. I'm gonna say this is a 4.25, which is a high rating for me. So
excellent.
Well
done. Well,
that's
good.
Thank you.
Yeah. Well, so Wilmington Brewing, has their work cut out. Tropical Lightning, the one that Kenji has, is probably just a little tiny bit better than this, and I'll still give this one 4.25 with you, Matt. So
that's great. Awesome. Well, thank you so much for joining us on Drink While You Think. Appreciate Live Oak sponsoring by sending us beers, because that's the easiest sponsorship of all time. And
it was. It really was.
We're looking forward to seeing you at AICPA in a couple of weeks, man. So,
All right,
it's
man.
like next week if you're listening to this podcast.
That's
So
right.
it's
That's right.
It's like,
Stop by and see me. We'll have a booth there. So
thanks everybody. Talk to you
thanks.
later.